My name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the hour is Ryan McMaken, author of Breaking Away. We're going to be talking about the Fed and maybe breaking away from the Fed. Maybe different forms of secession. But Ryan, introduce yourself here to the audience. Who are you? What's your background? And what are you doing currently?
Yes, well, at the moment, I'm a senior editor with the Mises Institute, which is an economics research center. If you've never gone there, check out mises.org. We cover a variety of topics, but certainly one of the central topics that we've covered for ever since the website was launched back in the 90s is the central bank and money issues, business cycles, that sort of thing. So things are a lot more interesting when there's instability. Unfortunately, that's when we get more readers, when there's unpredictable stuff going on, and that certainly seems to be the case right now. So we've got even more content than usual on business cycles right now. Now, my background is really more in state government and state financial policy. I used to work for the state housing division and specifically on their foreclosure stuff and on housing reports. So I spent about 10 years there working on housing legislation, mortgage stuff. Well, that's mostly federal. There's certainly some regulations and issues that take place at the state level. So I'm old enough to have been involved in the housing crash of 2007, 2008 when I worked on a foreclosure task force back then. So it is interesting to watch some of the new stuff unfold now. It's of course different, but there are some similarities.
So I think you said something which is interesting, which I agree with. Instability creates viewership and clicks, right? Gets more attention. I wonder if instability kind of breeds on itself in the sense that people want to know what's going on. They see the economy is acting in a volatile way. They pay more attention. They feel like actions need to be taken to resolve the instability, and every single action that's taken then creates more instability because of unintended consequences. Are we in this kind of interesting feedback loop in terms of the perception around instability and then what creates instability because there's a desire to keep on doing something about it?
Yeah, I think unfortunately what happens is people generally aren't paying attention. They think that things are fine, or they think that the market is generally unregulated. Um, and because they just don't see most of the regulation that's behind it. Now, of course, if you work in the field, you're well aware of all that stuff, the high cost of compliance and all of that. But if you're just buying a home or you're just renting an apartment, you're not nearly as familiar with that sort of thing. And so what happens then is when you start to see that, oh, I might be evicted, I can't pay my rent, how do I prevent this from happening? Then you just assume that there must be some law you can pass that'll make your life better. And so that's what seems to be always the reaction is there's got to be something government can do to improve the situation because they're unaware of what had already been done 5, 10, 20, 50 years ago that created the conditions that create the current problems. And so it's just a constant problem of laboring to explain these things because just the average layperson just doesn't have time to keep up with this sort of information. And so the relationship is just simply, oh, things aren't working the way I hoped. So clearly there must be some law or regulation we can pass that'll fix it. But that's not really how that works. There's already layers upon layers of regulation, and the reality is that a lot of that stuff should probably be repealed if you're trying to improve the situation.
Yeah, no, I think that's an important point, right? The idea that which is complex is more fragile. So if you want to make the system more robust, more anti-fragile, you've got to make things simpler and not have as many policies in place to try to fix other past policies that have unintended consequences. Now, that is a good transition to the Fed. Okay, in terms of the policies the Fed has put in place over the last decade and what's been going on more recently. Now, I know you want to talk about sort of what's the real problem? Is it higher rates or the fact that rates were kept low for so long? First, lay out for the audience your view on the last 15 years or so, really kind of post GFC. What do you think the Fed got right, and what does the Fed not get right?
Yeah, what we're living through now is we can really trace most of it back to 2008, 2009. And of course, there's a much longer history to that. Of course, we go back to the early days of Greenspan, 1987, 88. A lot of, I think, what Wall Street started to take for granted in terms of how the Fed relates to the financial sector goes back then, maybe even to the early 80s. We're talking about the financialization of the economy and how it began to shift away from an economy where you mostly have to invest in people and machine tools and land and capital in order to develop things. But as the economy became financialized, it made more sense than just to purchase financial instruments and to really just put money into a very low risk financial sector that had been created by the Fed. But that has happened and existed over the last 40 years, but it's really been taken up a notch since 2008, 2009, because it was during the last crisis that we were just told that all of these organizations, such as Fannie and Freddie, such as major banks, were going to require a lot more liquidity, a lot more financial oversight and intervention in order to make things work. And so, and of course, what George Bush was saying was that, hey, I have to basically get rid of capitalism in order to save it, the same sort of FDR line. So it was just, we've got to do all of these things or capitalism will fail. And what it ended up doing was greatly centralizing the financial sector and making the financial sector much more reliant on Fed meddling in the form of very low interest rates, near zero or zero interest rate policy, as well as this huge portfolio that the Fed developed over that time, buying over $8 trillion in mortgage backed securities and government debt as part of its plan to both keep interest rates low and save the banks by propping up their portfolios, especially by buying these mortgage backed securities. Otherwise, housing prices would have gone way down. These mortgage backed securities would have gone belly up. It would have been a big problem for banks, but the consumer would have benefited, but they didn't want that to happen because uh, so much of our political regime is geared around saving the banking sector, and that was so much of what was behind everything that we witnessed in 2008, 2009. And it's never been reversed. It's never gone back to normal. And so we're just really looking at phase two or three or a later phase of what began back then.
Yeah, and the banking sector wouldn't need to be saved if you simply had, real control over the leverage in the system. And the problem you and I both probably would agree on is that there's never an incentive to lower leverage because leverage creates the illusion of wealth, which gets people in office.
Yeah, I mean, often there's a question of, well, why don't these banks, why don't they see what the problem is? How there's all this easy money and it creates risk of default later. It could even create interest rate mismatch, like we're seeing now, yield mismatch. And why don't they just refuse to partake in that system? Well, the reason, of course, is that they can't compete then if they do that, right? Because their competitors then they're engaging in all this search for yield, and they're entering into all these high risk investments, and they're getting the high, short, and medium term returns then. And nobody can predict exactly when the system goes into reverse and deflation hits and a lot of it comes crashing down. So in the meantime, what do? You can't just sit back and lose market share. You feel the pressure, your stockholders want you to do it. You've got to engage in all this risky stuff that's encouraged by the easy money regime, and then you end up in big trouble later. But what are you supposed to do in the meantime? So it's an environment created by the central bank, and as a financial institution, you either participate or die. And so people mostly choose to participate. And then you end up in big trouble later.
The perspective that what we're living in now is an anomaly, I think, is one that a lot of people put out there in the media. I myself say that when it comes to market dynamics, but I do agree that the real anomaly was, keeping rates for as long as the Fed did in the absence of effectively a Great Depression. Um, why did the Fed, with hindsight, keep rates so low? I mean, is it just a function of they were so afraid of raising rates? They thought the inflation data was too weak, but that had flawed assumptions. How do you explain the sort of policy over the last decade relative to where we are now?
I think that was a big part of it was that the reality they knew at the Fed wasn't the same as what they were saying about the economy. So you're reading the beige book year after year, month after month, and after 2012 or so, because the economy was still real weak until about 2012, 2013. And you didn't even really see median personal income, real personal income, median family, real income, either of those things really get back to 2001 levels until about 2018. And then it really started to take off in 2019, just as money creation started to accelerate again. And so there was a long period there of really weak economic growth, even though in the beige book and the Fed press conferences, they were always talking about how the economy is strong, it's moving forward, everything's improving. It was always at least moderately strong. And yet they never raised rates and they never started selling off their portfolio. So their demonstrated preference apparently was was to not do that, because they must have just been afraid that if they did that, it was going to hurt Wall Street too much. It was going to make the values of these mortgage-backed securities and other assets collapse. The other issue is the political issue in terms of keeping interest rates low for the federal government as well, because during this period, the national debt continued to increase so quickly and so fast. It really shot up after 2009, and it slowed down, but of course never went back to where it had been before. And as that's piling up, you have less and less of an ability to pay 2, 3, 4% interest on a debt of that magnitude. So you're talking about 10 trillion, then 20 trillion, and now it's up to 32 trillion. And with each passing year, as it increases greatly, even just a doubling of interest rates, let's say it's 1.5%, it just goes up to 3%. Well, suddenly now you're paying 600, 700, 800, 900 billion dollars in debt service. And that's a big political problem for the central government, because now they've got to cut into things like defense spending, they've got to cut into Social Security and Medicare and other things that are very, very popular among a large number of voters. So you can be sure that they were applying pressure on the Fed to keep interest rates low there as well. So I think it was at least two pronged. There are probably other reasons too. To both, they were afraid of weakening the economy, because what happened in 2019? That's when they started selling off the portfolio, and they only did that a little bit for a couple of months, and then suddenly they have the repo freak out, that crisis. They suddenly have to start QE again, and all the indicators started to point toward recession in 2020, even if there had been no COVID. So they were right actually to be afraid. It turned out the economy was really pretty weak. But then they just changed everything by essentially engaging in by helping the Feds engage in $6 trillion of deficit spending and just flooding the economy with new money. But yeah, the economy was weak during that period, and so they couldn't really let rates go up much, and at the same time let federal debt service skyrocket as well. So you look at those two things, and you can see how they were trapped then, and of course they're still trapped now.
By the way, the point on politicians don't ever really have an incentive to tell the Fed chair to raise rates, I think, is a bipartisan issue. It's not something, whether it's Republicans or Democrats, both, I think you'd agree, want to see cheap money.
Well, especially when their party's election is coming up,
Right.
right? I mean,
Exactly
if
right.
you're
Right.
right, you're the incumbent party, incumbent as in the White House, and yeah, you don't want them to do anything that might tank the economy. So yes, of course, you're just going to want them to start printing the money. Trump started on that almost after day one. He'd been criticizing the Fed before he got into office, and then he immediately started tweeting all day about how Powell should keep rates low and just start goosing the economy. And I don't know how much that affected Powell in real terms, but he certainly seemed to go along with it, because that's what happened throughout 2018, 2019.
So if we agree that the incentives are always there to keep rates low, the problem isn't what we've had the last year of raising rates to catch up to inflation. The problem is the buildup of the inflationary pressure, which was a process over the last decade. I've used that line many times before on Twitter. Inflation is a process. Deflation is an event. Um, do you think we need to have some kind of an event to really bring inflation down in a meaningful way? And if so, how painful does that maybe need to be?
Yeah. Well, I think it depends on what one means by an event. I mean, I think something that would count as an event was just it would be any sort of significant increase in unemployment, which would then bring with it foreclosures, evictions, those sorts of things. And that would certainly be an event and would lead to something like you saw in 2009, where people were finally losing those jobs that were in bubble industries and they had to move into something else. I mean, if you remember back in 2008, 2009, everybody, it seemed, had a job in real estate of some kind. I mean, your bag boy at the grocery store was a mortgage broker on the side. Everyone owned 3 or 4 condos. I mean, this was all what we call malinvestment, right? These were not these are not sound investments. They were not based on fundamentals. They were all based on the idea that, well, more easy money is going to ensure that the values go up and that we can just sell later, make more money that way, not by actually improving anything. In fact, we could let these properties deteriorate, but there would be enough new money entering the economy that there would be plenty of willing buyers later, and I could just sell it for more then. So that's not how an economy should function. There should be actual savings and investment, accumulation of capital and quality capital. And that's not what's happening when you have an economy that's addicted to easy money and based on primarily inflating the money supply. And yeah, you're right. I think that's a good way to put it, is that you have this long, slow inflationary process, and it causes the economy to structure itself in a certain way to chase after these particular industries where the money lopsidedly enters and props up those industries. The thing about inflating the currency is it doesn't enter the economy evenly. It's not like just all prices everywhere go up at the same rate at the same time. It enters the economy through certain places, through the bond markets and through mostly through the financial sector first, and then it filters down to those people who are farthest from the financial sector, and they're the ones who suffer the most actually, and pay the most inflation without pay the most in price inflation without actually getting many of the benefits first. But if you're like a bond dealer and you're a hedge fund manager who can adjust quickly and chase the yield before things adjust, then you can do pretty well for yourself. But that can take years to really play out. And then it causes people, new graduates, people retrain. They then enter into those parts of the economy that are the bubble economies built on this easy money. But then eventually it all comes crashing down when it can't be sustained anymore because it becomes clear that those industries are actually hollowed out, that they haven't actually been based on any sort of real investment or planning or fundamentals, and that's when people start to really lose their jobs. The problem is that once that happens, people then maybe are going to seek very wrong solutions to the problem, as has happened many times before.
Right, which again goes back to the earlier part of the conversation, creates unintended consequences and other problems. Now, I want to relate that to the dollar, and I see you just put a piece out a few hours ago why the dollar still beats the euro and the yuan. Um, I thought inflation was supposed to be bad for the dollar, and yet the dollar, especially last year, was the best inflation hedge, ironically, in the way it behaved
Yeah.
against every other currency. Right? How do you think through this kind of buildup of inflationary pressure and the disconnect in terms of the dollar's movement? I always go back to in 2012 when the Fed started quantitative easing three. Back then, everybody was saying the dollar's going to collapse. It's the end of the dollar. Hyperinflation's coming. That ended up being the bottom for the dollar. And the dollar's still pretty strong. I'm curious to hear your thoughts on why there's a disconnect between inflation and King Dollar being dethroned.
Well, you can never, of course, evaluate the dollar in a closed system of just the American economy, right? You've always got to look at the dollar in terms of how it relates to other currencies and how users of the dollar would evaluate the dollar's value compared to substitutes and alternatives. And like any other product or service, the value of that dollar is very subjective. It just depends on how much people think, how much value people think it has. And people, and there is no absolute value, right? It's a comparison, it's relative. And you look at that, and you just start looking at the other currencies, and you have to choose. Well, I gotta I gotta sock away my money. I'm losing value by just holding on to cash, to dollar cash. But What if I put my money into these other things like pound sterling, or I put it into the euro or the yuan? Well, is that going to help me out much? And it looks like, first of all, that a lot of these other currencies are inflating at or near or above rates similar to that of the dollar. So certainly there's no easy place you can put your money in where there's not inflation. And so all these other currencies are losing value as well. And then you have to weigh that also against, well, are these other currencies as liquid as the dollar? In that, well, can I trade them in for other currencies very, very easily? Are most people willing to take these other currencies? Can I use these currencies to settle international trade transactions? Can I buy oil with these other currencies? And the dollar, since 1945, has been so well entrenched as the currency that can do all of those things that a lot of people would probably even be willing to take a slightly more depreciating dollar than these other currencies because of all the advantages it holds in terms of liquidity. And then on top of that is the fact that you need dollars generally to buy US securities. And those are still seen as, and by that I mean treasuries, those are still seen as really very safe. They're extremely liquid. They're almost dollar substitutes in many cases. And so there's a big value to holding on to dollars there as well, because you can just pour money then into treasuries, especially as their interest rates are increasing. So it's good to have dollars handy to do that as well. And it's those treasuries have much more liquid markets than these other government debt instruments from Europe and China and wherever. You can get them everywhere, right? So it's just way more advantageous to have dollars so you can buy that stuff as well. So you need dollars so you can buy both American stuff and American assets. And of course, we're told, oh, America doesn't make stuff anymore. Well, it makes a fair amount of stuff. And America also has a lot of services. And then there's all those American assets that people want to buy. So you need dollars for that. And the US economy is still pretty huge. Now, that's not going to be enough by itself to save the dollar, but I think it's going to prevent its collapse, or rather put off its collapse into the future much further. And so a lot of things are going to happen. There's got to be a lot of real structural problems for the US and somebody else, and not necessarily just one currency. There's this belief that you can only have one world reserve currency at a time. History shows that's not true. There have often been cases of two or three or maybe even four competitors going at it at once. When we look back to, say, the pre-World War II era, but you got to have some other currencies that are going to look relatively good in order for the dollar to really be dropped down to a competitor on a par with these other currencies.
You also need to have a true competitive legal framework, right? I mean, part of the reason why that money does come to the United States, that treasuries, other pristine collateral, is you can be confident that there's a legal system in place that will protect your assets, your property rights.
Yeah, well, you of course you need a macroeconomic system in place that looks like it generally respects private property. And of course, as Americans, we're very critical, of course, of the Mises Institute of the regime and the regulations and the way it devalues the dollar. But it's all relative. You got to look at the U.S. in terms of, okay, how well does it respect property rights compared to Argentina or compared to China or other potential competitors, including Western Europe, right? Is that none of those places look especially golden compared to the US. The US is good enough for the dollar and for its treasuries to continue to look relatively attractive. And how much confidence can you have? I know there's plenty of China optimists, but how much confidence can you have that China will not expropriate your capital that's there physically? And so that's real geopolitical risk that's still very much in place, and those are things you have to worry about it. So yeah, the legal framework is very much an issue.
So, I mean, is it fair to say that you believe that de-dollarization is a longer term trend, but it's not a sudden overnight dynamic that people should be worried about now, and the implications of that? I mean, there's been a lot of headlines the last couple of weeks around things that would make people think that the dollar is going to be dethroned. I use that term in the top of the Twitter space, and second time here. But um, are a lot of those just kind of clickbait or is there something really concerning as far as longer term, the idea of the dollar being the global reserve currency?
Yeah, I think what would happen first, the reason you don't have to just dump your dollars immediately is that even if the dollar then starts to go into decline, history suggests that there would still be a period there where the dollar would be a world reserve currency, just not the one anymore. So say that, yeah, the dollar declines and it's instead of being 58% of foreign reserves, it's now 30%, and the euro rises to 28%. And so now the dollar has to compete. That restrains the U.S. regime quite a bit. The regime can't inflate quite as much. It can't bully people around as much with sanctions and locking people out of SWIFT like it likes to do these days with countries like Russia and Iran and all of that, and just openly discouraging people from using the dollar. I think it would rein the regime in on that. But in terms of like a normal person who holds dollars or wants to invest in treasuries or something, that it's not that the bottom just completely falls out in that scenario. It's actually you have more choices. Maybe you could put some of that money in euros, but it's not a motivation to dump all your dollars and move them into euros. And even with China moving up quickly, it's going to be a while still before they're up to even euro levels of influence and use in terms of the international system and central bank reserves and that sort of thing. And what the way I would frame a lot of what this stuff being said about the dollar being replaced is that a lot of it seems to be framed more in terms of just anti-China hysteria, and that was a big theme in the Fox News piece on de-dollarization was, oh my goodness, the dollar is going to be replaced by the yuan. Well, de-dollarization and replacement by the yuan are two different events. They don't necessarily go together. You could have one happen without the other. You could just simply have the dollar decline with a moderate increase in the yuan. It's not; these are not the only two currencies in the world, so that if one declines, the other necessarily goes up in equal amount. So you got to keep that in mind. So yeah, I think they really are wrong when they just say, yeah, the dollar will be soon replaced by the yuan at comparable levels. That does not seem like that's right around the corner at all. I could see people hedging their dollars with use of other moderately popular currencies like the euro and maybe even pound sterling, especially if those currencies show some willingness to behave in a more independent manner from the dollar. That might help reduce some geopolitical risk by just decentralizing your risk, essentially. But yeah, keep that in mind. I mean, when you see something and it's geared mostly around, hey, fear China, then I think maybe they're missing half of the story about what's really going on with de-dollarization.
So I haven't really thought about this too closely, but as a thought experiment, would longer term de-dollarization be disinflationary or inflationary? The reason that it's not clear to me is, so the effect of of de-dollarization should be a weaker dollar, which is importing inflation. But to your point, the government then can't inflate its way because it's no longer the reserve currency. So kind of what wins out in that tug of war?
Yeah, that's an excellent question, and I do not know because a lot of that would depend on how the U.S. regime responds then to it being reined in. So if the U.S. regime was responsive to indications that people didn't want dollars as much anymore, they would start to get responsible with the dollar. Well, okay, we're going to rein in deficit spending. We're gonna and we're gonna really focus on really bringing deficit spending under control, so that we're not continuing to drive up necessary interest payments on that. So then maybe we can allow interest rates to increase a little bit, and that will lead to more capital accumulation and a stronger dollar, and that'll be good for entrepreneurs. It's hard to believe that that will be the initial reaction. I could see how after a time they might eventually learn their lesson, but I'm fearful that, yeah, even if global demand for the dollar goes down, the US regime will get the memo much too late and will continue to be reckless in terms of its inflationary policies. And then that will be bad for Americans, at least in the short term, and maybe even in the medium term. Unfortunately, there would have to be some movement to really rein in this deficit spending, the Fed's constant meddling in terms of QE and its ultra low interest rate policy to really rein that in as well. I mean, I like the idea of a strong dollar. I don't see why we should make all of our monetary policies serve exporters. I mean, it's there are other people in the economy as well who benefit from a strong dollar and from stable prices and from growing values there, especially just ordinary consumers who can then, of course, buy more foreign goods. And so there are all those moving pieces to consider. Unfortunately, I don't think it's automatically deflationary because of the way the U.S. government could react and the Fed as well.
Yeah, no, for sure. I mean, that's why I go back to it gets to be complicated in terms of those secondary, tertiary sort of actions in terms of the broader economy. Let's pivot a little bit to what I've called publicly the manufactured banking crisis with these regional banks. Um, I'm a cynic by nature. I've made this point before that you're in a pre-election year, and one way to justify stimulus and high inflation is through a banking crisis that enables the return of QE, which you can argue is kind of what happened, given the way the balance sheet responded. First of all, I'm just curious to hear your take on what's happened the last month or so. Do you think that this is largely over? Are these isolated events when it came to these regional banks, or is there a delayed effect that means that there's going to be, going back to the point about deflation as an event, that there could be an event still looming?
Yeah, that's the sort of thing I don't like to wade in and make predictions on at all because I'll say, yeah, it's over, and now there'll be another bank failure tomorrow that I didn't notice. Yeah, as far as Silicon Valley Bank goes, right? They're an interesting case study in the sense of they were doing what they were supposed to do as a bank, in that they were investing in treasuries, they were buying safe stuff, but that the Fed had created a situation where they were now in this game where the Silicon Valley Bank was buying this low interest rate, longer term stuff, and then suddenly now they were going to, if they were going to compete for depositors at all, they were going to have to pay out more. We of course all saw that with the savings and loan crisis 30 years ago. Well, 30 years ago, yeah, 33 years ago, something like that. And that you have a similar phenomenon at the moment. It doesn't seem to be nearly as widespread, partly though, because so much of the economy since Dodd Frank has been concentrated more in large banks. And so, in terms of just like a general contagion or something like that, does look like it's limited to certain banks here, and especially if you look at what the deal was with Silicon Valley Bank, in that I think only 6% of their depositors were in under the $250,000 FDIC limit, and it's closer to half, I think, at one of these normal big banks. And so just that there were so many people, billionaires and venture capitalists, holding millions upon millions, sometimes billions of dollars at these banks that run insured, that was just asking for trouble. I wonder if the part of the reason they were doing that was just, hey, I know, banks just get bailed out. And so maybe as a depositor, I'll get bailed out too. Sure, they'll let the stockholders eat it, but I can be sure as a depositor, I'll get my money back, even if it's technically not on the books right now. And they were right, of course. That's exactly what happened. I do think there is risk of that continuing to happen, but the fact that they're just saying now that effectively, well, you're getting mixed messages on that. One of it is, well, we're essentially insuring all deposits to infinity. But then you get Janet Yellen go up there and say, well, we'll pick and choose which banks will bail out and which we won't. So that causes some uncertainty as well. And that probably is a good reason to leave the smallest banks. And the small banks have been at such a disadvantage over the last 13 years or so, where so much of the stress tests and the regulations have been really geared toward favoring the larger banks. And if you're small, you're regional, you can't offer the super low interest rates on loans. You're catering to local small businesses and farmers and that sort of thing. These are just making your life very, very difficult as a small regional bank. And just managing that situation is very difficult. So I can see how these banks got into trouble. Um, the question is depositors, are they going to see that as a reason to pull out their money, or do they think it's safe now? It does look generally safe. But maybe you just want to keep at least the lion's share of your money in a big bank, because then you just don't even have to worry about it. And I think there is a continuing danger of that in seeing that, well, maybe I should at least just move some more of my money to the big banks, so that reduces then deposits at the little banks. And then the other issue is, boy, these banks are still paying next to nothing in terms of interest on my deposits. So I should just put them into money market accounts or treasuries or somewhere else outside of this bank, and that could eat into deposits as well. And then those banks are just going to get into trouble. And that does seem to be an actual trend. Deposits don't seem to be doing so well. And if that continues, I think that'll impact the smaller banks, and it could turn into a issue that could really heat up. The question is again, I have no idea what the timing might be on that, and when the next trigger event to make people fearful could happen. Yeah, I know the IMF has tried that for a very, very long time, and I guess it just hasn't caught on because the dollar has been good enough during that period. And it looks like the model certainly hasn't died out. BRICS seems to be, maybe that would be what they want to do, or maybe the Argentina Brazil agreement. I don't see any a priori reason why that couldn't work. It would require, of course, another level of management and bureaucracy, I think, to really determine what would that basket look like and who would be in charge of it. It seems like it would remove it from the markets one extra step, and that doesn't strike me as a good idea. But it's not like we're in a laissez-faire system here now. Also, that could be used as a political cudgel to, oh, well, we're removing your currency from the basket now, so tough luck, or do what we say. So that's an additional issue. But yeah, I wouldn't dismiss it with just hand waving, saying, yeah, that could never happen. It strikes me as possible, and possibly a workable system for a while. Certainly not my ideal system, certainly not a system I would want to see, but in terms of could it happen and could it be sustained for a while, seems to me like that's a plausible claim. Well, yeah, lots of good points there. I think you always have to keep in mind, right, the bank mechanism, the commercial bank mechanism in terms of money creation and money destruction, right? Money destruction does happen also. And we've had a number of good articles. I would recommend check out Frank Shostak's articles at Mises.org, because he covers that a lot. How deflation happens through the commercial banking system, and that is a counterbalance to the inflationary forces we're talking about here. And so, yeah, never forget about how that's an issue. And then I think the larger issue here, then, yeah, is taking into account the impact of the euro dollar system. Now, you'll notice I did not bring up the petrodollar as a reason why the dollar is going to collapse next week. Now, you have been hearing a lot about that, how the Saudis have talked about how, oh, yeah, well, we're open to trading oil in other currencies. And you've seen then that fact reflected, especially in the Fox News bid and also at CNN, saying, hey, well, as soon as people stop using dollars for trading in oil, well, suddenly the game is up and nobody's going to need dollars anymore. Well, you got a couple things going on there. One is that, again, just because they might use other currencies doesn't mean nobody's going to use a dollar anyway on that. But you could also just look at the petrodollar as a type of euro dollar. And it's a small part of it, really, when you start looking at just how huge the euro dollar markets are. And we don't actually know exactly how huge they are, but huge and larger than the US economy, as was just noted. So we're now needing to take into account all of those issues. And I think there's no way to really directly observe in real time what effects US inflation or changes in demand for the dollar are having out there in the euro dollar market, because it's not directly regulated by the Fed or under its control at all. It's this large amorphous market that's out there and does and functions more on just more straight demand for what the dollar is related to other currencies. So I think we'll know more in the future, but for now, I don't think we can say a whole lot about how recent events have affected demand in that market. And that is another place where, just as the dollar currently dominates foreign exchange transactions, foreign trade, settlements, as well as reserves at central banks. Also, it's just there's this huge euro dollar market as well. So yeah, that's something that we should definitely consider.
And actually, I'd love to do another space, maybe with the two of you kind of going back and forth, but maybe just for the last few minutes, given that we're coming up on the top of the hour. I want to give you a chance, Ryan, to briefly just talk about your book, because it sounds really fascinating. It sounds a little, just by the title alone, a little inflammatory, but from the reviews, a lot of people are of the mindset that it's actually very thought provoking. Talk about breaking away.
Yeah, the I in my work here at the Mises Institute, one of the other topics we talk about a lot is just the issue of political decentralization. And if I'd had the time, I would have actually included a whole section in the book, which was on monetary decentralization, which is an important issue. Unfortunately, there's not much about that at all in the book, but we are talking mostly about political decentralization, perhaps, and territorially, as is often the case. But you could decentralize in other ways as well, using confederations and that sort of thing. So it's really more in the realm of international relations, the history of the state, that sort of thing. I think a lot of people, when they think in terms of, because the subtitle of the book is The Case for Secession, Radical Decentralization, and Smaller Polities. And what I wanted was a book that wasn't another book covering American issues related to secession and constitutional federalism and all that stuff. There are a lot of good books on that topic that already exist, some of which we sell in our bookstore at Mises.org. But I felt we needed a more global and a more modern view of it. So, what this book really looks at is the issue of what does decentralization mean in the modern context? Where has it happened recently? And what are the effects of that politically and to a certain extent economically in terms of free trade, openness to migration of workers, labor, distribution of capital, taxation, all of that. And if you can find lots of examples, both 100 years ago and more recently as well, right? Because we had the whole decolonization process, and then we, of course, had the end of the Soviet Union. So since 1945, the number of independent states in the world has nearly tripled. How did that happen? Through decentralization, radical decentralization, and through secession. So I'm trying to look at a more extensive and detailed, kind of commonsensical view of what does that mean, and is that an option for people in the Western world as well. So even if you're not interested at all in things like 19th century American wars over secession, this could be a book that you might find interesting because it looks a lot more at what other parts of the world have been doing on this issue, as well as just some of the theory in terms of, is it better to be in a small country like Switzerland in terms of your economic policy, or do large countries have the advantage? And so I try to look at some of those issues.
And that's available on Amazon for those that are curious. So we're at the top of the hour here. Special thanks to Ryan McMaken. Make sure you follow him. FCF, George Gammon, also always a great follow. Thank you, Ryan. Do appreciate your knowledge here.
Thank you.
Cheers, everybody.